Yeah, hi everybody. My name's Richard Brady. We welcome you to today's webinar on taxes, and it's good to have you. Just by way of introduction, we may have a number of folks either on from New Mexico, Texas, or the Southwest. And so as we talk about taxes, that kind of would apply to each of you differently, but I think we're going to address most of your questions. Make sure if you're new to Zoom, make sure there should be at the bottom of your screen, there should be a chat button. And so please share your question with everybody that's online. By way of housekeeping, we're going to take about 25 minutes, 20 to 25 minutes, and answer some questions, go through some of the tax deadlines that we're facing, and share that with you. We are recording today's webinar. And so if you would like a recording of this to share with either family or friends, feel free to ask for that. And we'll make sure we get that to you here in the next day or so. I'm going to go ahead and share my screen here, and we will get started. All right, excellent. So everything you need to know about taxes in 2021, of course, that's a bit of a misnomer. We're not going to share everything you need to know. A little bit of a disclaimer. Obviously, I'm not a CPA. I'm a financial advisor. So, but so much of what we do as we prepare for taxes tied to investments and also have huge amount of tax implications. So we want to make sure that we are working very closely with your CPA and giving you sound advice. So we're not going to go into a huge amount of depth today related to tax. If you do need specific tax advice, we recommend you reach out to your CPA or your tax advisor and make sure that that you take advantage of that. So what we do, I first off wanted to share where this fits. We have 5 pillars or 5 key major initiatives that we help our clients with in our firm. Tax is obviously one of them. It ties into investments. It ties into overall retirement planning. So we've got to make sure that we're being wise, and we're going to touch on several points that you may want to consider in tax planning that are tied to your investments. But when you work with us, we do encompass these 5 key areas: tax, investments, income, which is what is needed in retirement, which is really the foundation of retirement. But we also go into healthcare management, Medicare, Social Security, and some of the government provided programs, as well as estate planning. So we do provide comprehensive planning. Today, we're going to talk a little bit about tax, which we're excited to do. By the way, I've also got Brandon Thurgood, who is online with me. If you have questions, or if I miss your questions, Brandon will he'll be sure to catch that and share that with me as we're going through this. So what you need to know about tax deadlines that are coming up. We're going to talk about 3 things today specifically: changes to the tax filing timelines, which really impact all of us, regardless what state you are in. You've got to know some of these changes, and it gives you some latitude for various reasons that we'll go into. There are differences in contribution limits depending on what retirement vehicles you're in. And then lastly, your investment strategy of both an IRA and a Roth. What are the different kinds of considerations that we take into account when we make decisions where to invest your money, because there are tax consequences as a result of that. So let's jump in. Tax filing timelines. The federal tax timeline, you may want to write this down, has been changed. We're all familiar with April 15th. That has been pushed about a month to April 17th. Now, don't ask me why in the world they chose April 17th. I'm sorry, May 17th. April 15th is actually a Thursday. May 17th is a Monday. I have no idea why they chose that day, but hey, we'll take it. The reality is this, is that they've given us a month extra. And the reason they've done that is really tied to many of the discussions we have that there's been tied to the Biden initiatives and some of the government stimulus that's been injected into our economy, unemployment, other more complex considerations around income. They have chosen to give us an additional month to work through some of those tax complexities. So regardless what state you are in, you now, in order to file your federal taxes, you have until May 17th. Now, the disclaimer there, your tax deadline may not be delayed. So you need to, regardless what state you're in, make sure you know when your tax filing is required. Obviously in Texas, there is no state tax. For those in New Mexico, there is. So know your state tax deadline, but your federal tax can be delayed a little over 1 month to May 17th. I also put that other second point there, that penalties and interest. What that means is that those will begin to accrue after the May 17th. So they've given us, if you will, kind of this window in which they're not going to start penalizing those that are late, and they're going to give us some, you know, a holiday, if you will, for about a month. Now, the key point I wanted to highlight, this does not extend contributions, though, to your IRAs, to your employer plans, to your HSAs, to your Coverdales. So as it pertains to making contributions for those different types of investment options, you must still meet the April 15th deadline, okay? So make sure you're taking advantage of that. If you have specific questions, you can call your custodian and say, where I live, do I have until May 17th? But what I have read and what I've researched, there is not going to be this, you're still obligated to contribute to your IRAs, your Roths, et cetera, by April 15th. Now, there is an exception. There always is an exception to the rule, isn't there? So for those of us that are special, by the way, I did mention that I kind of run our Austin operations for Oxford Wealth. And I do live in Texas, and so this directly impacts me and those that we work with here in Texas because of the FEMA declared winter storm that took place about a month ago, and that we are still recovering from, by the way, that Texas, Oklahoma, and Louisiana by FEMA were given additional time. That was negotiated with the IRS. So anybody sitting in Texas, Oklahoma, or Louisiana, just know that you have more time. The deadline for those living in those three states is January 15th. But it does allow for those living in those states, we can wait until we file for taxes in mid-June in order to contribute. The take-home message here that I'd like you to leave with is I would recommend you still take the conservative approach. If you're planning on contributing to a 2020 IRA, Roth, et cetera, get that done by April 15th. That's my general recommendation. It does appear that those that live in Texas, Louisiana, or Oklahoma do have a little more latitude to do that. Okay, so April 15th is your key timeline. So let's talk a little bit about contribution limits. That's important. I will say that much of these limits have not changed. It's the same now. It was really the same in 2020 as it is in 2021. If there's a difference, I'll highlight that for you, but just consider it to be the same for 20, same for 21. For your IRAs and Roths, if you are less than 50, just plan on, if you are under the age of 50, you can contribute $6,000 a year. If you are over the age of 50, you have what is called a catch-up provision. You can contribute an additional $1,000 per year, or for a total of $7,000. Now, key point with IRAs and Roths, just remember that this must be earned income. And please remember that there are tax deductions for IRAs. There is not tax deductions for Roths. If you contribute to an IRA, there is a gradual phase out based on the income that you have. If you want to ask questions specifically as to whether you're going to be impacted because of your income, check with your CPA. Or there is a lot of information already out there online that I would point you towards that can answer this question for you. For those that contribute to Roths, which we highly recommend, and by the way, side note, if you don't have a Roth, make sure you're talking to your financial professional about contributing to after-tax contributions. Please remember that Roths grow tax-free. And if you are not in a Roth, take advantage of it. Talk to your financial advisor, get one set up. It's easy to do, and all growth is tax-free. Roth contributions, though, do have income restrictions. You got to make sure you take advantage of. So if you have questions on that, talk to your tax professional. If you're contributing, what are your limits with a 401k or a 403b or a 457? They are higher. If you are less than 50, you can contribute to $19,500 a year. That's what I call regular. If you're over the age of 50, again, you're given more latitude to contribute an additional $6,500 per year, or for a total of, what is that, $26,000 per year. That is the same for 2020, and it is the same for 2021. For those of you that are self-employed, we need to talk. Let's sit down together and schedule some time. Contributions to SEP. If you are self-employed, you have the ability to create what is known as a SEP or a SEP IRA, because it allows for higher contribution limits. The limit is you cannot exceed the lesser of 25% of the employment net earnings, or 58,000. You can see very clearly as to why we are really high on SEP for those that are self-employed. You have more latitude to contribute more on an annual basis. Make sure you take advantage of that. If all you have is a 401k and you're self-employed, let's talk. Let's make sure that you are or are not able to set up a SEP. We can answer those questions for you. All right. The next direction I want to talk about is kind of related to, let's put taxes into 3 buckets. And I've done this for illustrative purposes because I think this really nicely illustrates that not all investments, or not all what is called qualified accounts, retirement accounts, are treated the same by way of taxation. So let's talk about the differences, specifically on income that's taxable. Well, what's included in this category? It's pensions, it's short-term gains, it's stock dividends. It's the income that's spun off of CDs, and it's dividends and taxable distributions from mutual funds and from your regular brokerage accounts. Okay, that's when we talk about taxable income. You have no choice. You've got to receive that income in the calendar year, and you've got to pay taxes. The second type I wanted to visit with you about is what is known as tax deferred. Well, what fits into tax deferred? Well, that's your regular IRAs. That's your 401k, 403bs, 457s. Annuities fit in tax deferred. Many don't know that, but annuities are tax deferred as well. And savings bonds. These are all tax deferred income. Now, it doesn't mean you don't owe taxes. It means that you are deferring or postponing until you need to pay your taxes. The third category is what is called income tax free. This is why I mentioned what I did about Roths. Roth IRAs are, all growth is tax-free. Municipal bonds are tax-free. And oh, by the way, again, I keep talking about Texas. I may be a little biased because that's where I'm from. But look, guys, here's the reality. If you own municipal bonds in Texas, we need to sit and talk. Municipal bonds are tax-free from a federal level, but if you don't have a state tax, you miss out on the benefit of municipal bonds. Plus, if you're in muni bonds, you also, it can impact the taxation on your Social Security. We need to talk if you're in municipal bonds and you live in the state of Texas. Life insurance. All 3 of these are major plays and things that are tied to your retirement accounts and are very much tied to taxation in your retirement years. So those are what we call, guys, the 3 tax buckets, and we've got to plan accordingly. Well, what do? Well, we believe, if I ask you the question, are taxes going to go up in the future, or are they going to go down in the future? We very much believe, and look, the reality is, and this is non-political, the reality is that we've got to pay for these stimulus packages that total about $5 trillion somehow, some way. And this money doesn't grow on trees. There's going to be a time, and it's going to be in the near future, I believe, not until the what I call the Trump tax plan that is due to expire the end of 2025. I think it's going to come faster than that. We have a Democrat-run Congress, and we have a president in the White House who is of the same party. I believe that there will be an increase in taxes in the short term, not even to the end of 2025. So what does that mean? I believe you can just think of it this way. Taxes are on sale. Taxes are on sale. So I believe let's move forward And if you are able to, go ahead and pre-position pre-qualified accounts and taxation, and go ahead and take the bullet and pay the taxes now. But let's have that conversation. It really depends on where you are in your tax bracket, and we can help quantify what that looks like for each of you. By the way, in the chat function, I did put what is called a Calendly link, where if you would like to sit down and visit with us, no cost, no obligation, just sit and visit about this tax discussion. Be sure to take advantage of that. We will absolutely sit with you and give you our assessment of your taxes and where you currently are positioned. So the idea being, if you look at this slide, we want to shift and move to tax-free, to the tax-free bucket from either your income that's taxable or from your tax-deferred positions. Now, to help with this from a conceptual standpoint, I wanted to just take a minute and explain to you a little bit about what all this means. So I took a bit of some liberties. Rather than writing on a whiteboard, I just put it all down on one sheet, and hopefully this will help. So on the left, you have an IRA and its attributes and how we as a firm kind of position ourselves in order to help our clients related to investments, meaning retirement accounts, and taxation. So let's talk about the differences then between an IRA and a Roth. An IRA is a before tax position. A Roth is an after tax position. In IRA, you can deduct the contribution you make in that year's tax statement that you have. A Roth is not deductible, okay? With an IRA, you pay ordinary income when you withdraw the money out of the account. So the question is should you start using your IRA now, or should you defer into the future? We're going to talk about that. A Roth is tax-free. So there is a difference in how we approach the investments that go into an IRA versus that of a Roth. And let me explain what I mean. If an IRA is going to be taxed, and we will frequently go into more conservative positions in an IRA. The reason is if taxes are on sale and you're going to be taxed, we believe that you'll be taxed at a lower rate today than you will in the future. So we will frequently recommend, if you've got a Roth and you've got an IRA, we will recommend we start withdrawing funds in your retirement years from an IRA. So what does that mean? Well, we will then go ahead and make an investment in less risk type assets or funds or positions. Why? Because it's got a shorter timing, sorry about that. And you're going to withdraw those funds sooner rather than later. So as a result, we will have a tendency to go safer, more conservative positions up front. And so the types of vehicles, which means the type of investments we will make with an IRA, will frequently be a CD or a money market or a bond or an annuity, something that is either guaranteed or less risk. And the types of investments we'll put people into are these types. AGG is a type of bond. An ETF, it's a bond ETF that's investing in treasuries and internationals and munis, but it's all kind of front-end invested in conservative investments. We may go with an SMA, which is called a separate managed account in 3Edge or Dorsey Wright. 3Edge is another SMA, which has the ability to invest in gold or in bonds or go to cash or equities based on what they see. They are what is called actively managed, so there's less risk. We also believe in companies like Midland National or Progressive or other companies that are very well financed. They have the ability to manage your money conservatively. So let's now shift over to Roth. It's after tax, it's not deductible, we talked about, but it is tax-free growth. So our approach is, again, as I mentioned, if you start in your retirement years in an IRA position, you then wait. You wait until the Roth account should be the last that you are ever taxed on. Why? Because you might as well shoot for the sun, the moon, and stars, because the growth is never taxed. So we will go more aggressive in Roth positions. Something like, and I just put a few that are individual stocks, Tesla, Visa, MasterCard. If you go look at their performance over the last 5 to 10 years, it's astounding. It blows away the S&P 500. We also like different types of ETFs that are actively managed, like ARC, or different mutual funds like T. Rowe Price, large cap growth. We like that mutual fund quite a bit. But here's the key message. If you're invested in Roth, or today, if you have a Roth and you don't know how you're invested, we need to talk. You really need to invest in highly appreciable assets in your Roth accounts. You want to go to the very edge of what is considered comfortable for you. Now, you notice I didn't say speculative. I just said more aggressive, something where you can get a greater return on your investment dollar. Okay, a little bit of our approach, but it kind of ties in with taxation. It ties into retirement planning. And those are the kind of considerations that we look at when we decide what should we put you into, what should we invest in, because there are tax implications as a result of that in your retirement years. These concepts also, by the way, generally apply whether you're 20 or whether you're 60. So we want to work and do that strategic planning that I think is just so critical. So putting it all together, what we can do with you as we sit down together, we will look at a tax diversification review. Let's look at your tax situation. Let's analyze it. Let's see what you're thinking about, where you're currently positioned, and then tie that into taxes. Taxes are going to be a major player in, a silent partner, if you will, that you can never divorce. You are always married to the IRS around this, and they want their money, especially as those of us that are 40 plus that have put a significant amount of our retirement dollars in IRAs. We're gonna have to pay those taxes. Well, perhaps we start the process of converting sooner rather than later. And if we do that, then we need to do that tax diversification review and talk about that. We want to look at assets. And then lastly, we want to put it all together in a retirement plan that focuses on income, that focuses on legacy, that talks about Medicare, Social Security, and that talks about income and asset positioning, like I mentioned at the beginning. Well, we're here for you. And as you can see, these folks, if we do all these, if we plan appropriately and plan correctly, you can be sitting on the beach, playing golf, doing whatever you value in your retirement years, and you can be as happy as this couple as they're enjoying their retirement in their later years. So here we are, guys. These are the two phone numbers you can reach out to. 505, which is our New Mexico number. We're actually located in Rio Rancho. That's our main line. And then here in Texas, you can call the 512-843-3400 to get a hold of our team here in the greater Austin area. Anyway, I'm happy to hang out. We've gone 25 minutes in. That's about where I wanted to go. But are there any major questions that you've got? Brandon, have we gotten any questions from anybody that's on?
Not yet.
Okay. All right, guys, Brandon and I are happy to hang out. If you've got any questions, feel free to reach out at any time. By the way, my email, if you would rather just email me, is rbrady, B-R-A-D-Y, at oxfordwealth.com. rbrady@oxfordwealth.com. Feel free to reach out and I can point you in the right direction. But those tax deadlines are some of the things to consider. If you've got questions on that, if you've got questions on your income streams in retirement, if you've got questions about investments or your taxes, let's sit down together and do a review. And again, no cost at all for any of these consultations that we have. And we like to, our company motto is that when you give out good, good comes back. And we believe in that. We believe that, and that's one reason we don't charge for any of our plans or any kind of consultation. So take advantage of that. Sit with us. You can see in the notes the Calendly link that you can ask for 45 minutes. I think we put on there 3 days next week, Monday, Tuesday, Wednesday, if you would like to. And just take advantage of that. No pressure. We'll sit together and go over your situation. So we appreciate you attending. And if you've got questions, just let us know.